Hi, Cal. Welcome to Venture with Grace.
Hello.
Okay, so to start the show, I would love for the audience to get to know you a little bit more. So you were working on you were a founder at the beginning, and then you worked on the LP side. Now you're a GP, and let's talk, or like now you're like a managing partner of like a different firm. So like let's talk about like your journey on like were some like lessons that you've learned early on in your career as a founder that you kind of took away to your VC career and like maybe LP career and then VC career.
Well, I have an interesting background because after I graduated, I spent 6 months in consulting, and after that, I went on to the LP side. I was analyst at a firm called Pantheon, where I worked for 5 years on the private equity secondaries and secondary direct team. And then after that, business school. That actually brought me out to Asia. I was in Asia for a few years, and then business school at HBS, and that was when I transitioned over to tech. Uh, Co-founded two startups. So the first with an HBS classmate of mine, a company called Scanwell Health. I was there in the very early days. I wasn't the CEO of that startup. I was a co-founder with my good friend Steven. Ultimately, that company had a great exit, 10 years later, because it takes a long time. I started my second company, ChoicePass. That company I was the CEO, and ultimately that company got acquired by Salesforce. It became Salesforce's HR cloud, work.com, and was at Salesforce for a couple of years, building that business before I moved into the venture side. I've been a VC for about 10 years now. The last 7.5 years, I was at a firm called DCM, which is almost 3-decade-old fund, very established, Sand Hill Road fund, $4.5 million under management. And then a couple of years ago, I left and joined my good friend Ben Ling to be the second GP at Bling Capital. Firm's been around for 5 years. We are an inception stage firm focused on pre-seed and seed stage investments, helping founders find product market fit. Like that's what we do every day. That's what we love. Everyone on the team has a product and engineering background, a founder operator background. And yeah, we just love what we do. To answer your original question of what are some like core learnings, I think the biggest one early in my career is work incredibly hard, because there's a compounding advantage, especially earlier in your career, to really build your reputation, build your knowledge base. It compounds over time. So that's one. That's one of the things that I learned. The second is really invest in your network early. So I remember at Pantheon having a couple of managing partners there who were mentors of mine, and they were just incredibly helpful with opening up their network, right, and introducing me to folks that they've known for 1, 2, 3 decades, in some cases. Introducing me as like the star analyst that had worked there. So I think that's incredibly important. And then the third thing is to be very thesis driven. So what I mean by that is in your career, you're really focused, like you're as a VC, we're investing time and money. For your career, it's like your biggest investment. And so how you invest your time is really critical. Are you investing your time at an early stage startup that you believe can be the next like OpenAI or Google? Or are you investing in a company that like you don't really truly believe like it has like kind of long-term potential, right? And so that's been incredibly helpful for my career, and like that's what I would say to folks earlier in their career.
I have a question for you. So since you invest in like a bunch of unicorns and then you invest in a lot of company that like kind of like acquired by a different company, I wonder like is there any significant differences when you're looking at them in like an earlier stage that kind of like separate them into this here's like because your company was like acquired. I think both of them are like very amazing outcomes. I wonder if there's any I guess like benchmark or like identification traits or something that you would see like a company going down like maybe different paths or like in general like basically thinking about exit.
That's
So
recognition at the very early stages and what we look for, and ultimately how they become unicorns. Or I want to just understand what.
so basically I guess like so there is I was thinking about like since like venture has like couple different roles, right? Like you need to like deal source and then you need to like doing due diligence, and you need to win the deal, and then eventually think about exit. So I guess like how do you think about exit? So I feel like a lot of people talk about like, oh, here's how we source deal. Like we know like 7 other people in our network that are doing a similar thing in an earlier stage, and then that's how we source deal. Or like, oh, we're like BFF with a lot of founders, all that. But I wonder like, but no one's talking about like, oh, when thinking about like exiting, like, what would a good outcome for a fund even look like, since you have a lot of exit? So I wonder like, how do you think about like exit at the beginning instead of like it's like an afterthought after you invest in like a lot of company?
No, it's definitely something that we think about from the very beginning as part of our investment thesis, as part of my investment thesis on like, how does this company exit? That's what every investor is thinking. Ultimately, does this company have the legs to go public? And what I mean by that is like, does the founder has an ambition to do it? Are they going after a market that is sufficiently large? So at a very high level, our thesis at Bling is compelling founders going after large markets. Because if you have a really compelling founder going after, like a small market or like a not a good market, then there's probably going to be like a very low likelihood that that's going to be a great success. On the other hand, if you have mediocre founders going after growing and compelling markets, you can actually have a great outcome. And then if you have compelling founders going after, what turns out to be a great market, you don't actually know if it's a great market actually when you first invest. That's where you have like the incredible venture scale outcomes. And then I get this question a lot, like, what is the thing that's most important? It's always the team. It's always the founder at the early stages, because we don't control when companies exit. Sometimes exits are manufactured. Sometimes they take years to kind of form a relationship with a potential acquirer. And sometimes you have the legs to go public, but it has to be the right time, right? The public markets you need to be ready. The public markets need to be ready. So there's a lot of luck involved with driving to those outcomes. Like I share a lot about, like, you look at Facebook, right? And so this is like pretty publicly known at this point, but I'd heard this through multiple early investors in Facebook in the early days when it wasn't as well known, is that Mark Zuckerberg got a acquisition offer from Yahoo for $1 billion, right? When the company was super early stage, I think maybe Series B, generating almost zero revenue, growing really quickly. For almost any other founder, I mean, that's like life changing to $1 billion cash, right? And he I don't know what the cap table looked like. Let's assume he owned like half the company. I mean, that's $500 million. But like, Mark's response was like, well, what will I do? Like, I'll probably just start another social network, and I already like the one that I already have. And so, Facebook is the company they are today, right? And so I think for every VC, the aspiration is to look for that next generational company that can be a Facebook or a Stripe or a Pinduoduo or a Meituan or a you name, like Uber, like that type of company. Obviously, like 999 times out of 1,000 that doesn't happen, and there's still great outcomes along the way. But that's always the aspiration, because of the power law in venture. And what I mean by the power law is just like, it's a small percentage of the companies that drive the vast majority of your returns.
I wonder, okay, so I want to like, so since you mentioned like, it's about the founder, and then I guess like, what would be the earlier, so like, basically, I think previously, like right before our chat, like I mentioned, like, I had a great conversation with David Chow. Like, I feel like this has been like very impactful in my like uh venture career as well. So like, this is like before I got into venture, I like published a book where I interview like a lot of investors on the Forbes Midas list. And then so although like I didn't like put in the book, but like I think one of the major lessons I've learned from him is like sales is very important for sales skill is like very important for founders. That's like what I've learned from the chat. So I wonder like when you are thinking about evaluating the team, so obviously I know that you have said this on other podcasts about like the person have to show some like greatness in certain category of their, like, it doesn't have to be a pedigree, but it have to be like within their quote unquote track record in the past to show some kind of greatness or excellency. But I wonder, like, what would be, let's say, like 3 things that you would use to, 3 questions that you would ask a founder to kind of like examine their like ability, or their like vision, or like their certain skills?
That's a great question. I'm not the type of VC that has like there's some VCs that have like they ask every founder like this
Yeah.
question or that question. I don't think I have like a specific question that I ask, but I typically am trying to figure out how ambitious is this founder. Are there any unique insights that make this founder the very best to go after this problem? And then the third is like how much charisma and how much there's a bit of like that whole like Steve Jobs like reality distortion field, like
Mhm.
oh I walked into this meeting being very very skeptical, and then you've like convinced me that like your state of the world is actually like where the world is going. And so it's really kind of a combination of those 3 things. And so with the first one around ambition, I will ask versions of questions like, what would you, and actually this is like a David Chow loves to ask this question, but like, it's like, what would you do, Grace, if tomorrow Google came and offered you $100 million to buy your company? And if the answer is absolutely not, I wouldn't think about it, I'm gonna go all the way, it doesn't sound really that credible. So we're not actually looking for you to say absolutely not. We're actually looking for like an answer that shows that level of ambition, right? Which is generally more nuanced. Well, I mean, it depends. If I'm doing, $1 million in ARR and it's not going anywhere, I probably will like sell and then like in 2 years start another company, right? Or it's like, if we're growing really quickly, there's absolutely no way we're going to sell, and here's why, right? So that's one question. The second, around kind of founder market fit, like why are you amongst the best in the world to go after this? The thing I'm really trying to understand is the unique insights, the unique earned insights that you have. And so there's that's where things can go in many, many different directions. But the ones where they are most insightful is when I come out of the meetings learning something. So I might ask something like, hey, based on your time working at like NVIDIA, like why do you think there's an opportunity to build this competitive niche here? And we'll see kind of how insightful they are, right? And then the third, around that charisma side, is not really a question, but it's just more kind of like the dialogue, right? I think that what's become like a really popular like question for folks is like, what is one thing you believe in the world that others do not believe, right? That kind of contrarian thinking. And so it's some version of that to really kind of understand like, okay, like can this person have that reality distortion? Because the most critical thing for early stage startups is actually not capital. I mean, capital is important because you need to have money. But what's most important is is this the team that is able to hire a rock star team? Because if you look at the data, no company ever makes it to the public markets or makes it to becoming a really kind of generational type company without being able to build like this incredible base of talent. And that will start with the founders.
Okay, I have a question on that. So I've seen some founder are great at like recruiting technical talents, that are like technical. Let's say if they're like a Stanford PhD, and then they're great at like recruiting other Stanford PhDs. Is that called hiring a rock star team, or should we go for like, okay, so our company needs a salesperson, so I'm gonna hire like the best sales I could hire? That's like hire a rock star team. Like, what is a rock star team in general?
Well, you're building a business, right? And so when you're building, like we care a lot about like, is this founder going and building a good business at the end of the day? Like, what is the business? And if the business is we're building proprietary technology that will take $100 million to ultimately kind of come to fruition, but there's incredible technology moats, then yeah, like the early team should be PhDs from top universities that are the very best in the field, and that alone is a differentiator, and there's many companies that have done that. Then when it comes time to monetize, then you need to hire a great go-to-market team. So it just really depends. If you're building, for example, a SaaS company, or you're building, now there's the very popular term like a vertical AI, or it's like a SaaS company, applied AI SaaS company, like where you're not building a lot of your own foundational models, and so therefore the differentiation is really in the data or the product, or the user experience, or some distribution mode, then you have to start thinking about go-to-market early. So it really depends on the company.
I wonder, so since you mentioned about like you guys are looking for the founders that are just like very ambitious, who are going after like addressing like a really big problem. So I guess I chatted with a lot of founders who are building in the moonshot area ideas. Um, let's say if they're building, I don't know, like the USB, plugging your USB into your brain type of things. What exactly would be the right benchmark to examine these kind of like prior non-existing, or like if they're mining asteroids, so or something like, so in general, like if they're like working in something that's very deep tech, or like the customer is like not your day-to-day SaaS company, or not your day-to-day like it's not like a CRM for like sales or something. So I guess like how would you evaluate if an idea, sure, they may have like uh the Steve Jobs like distortion, like reality distortion thing. Yeah, so like maybe they have that, but it's like when you come out of the meeting, you're like, okay, so the spell is kind of gone. Like, let's think reality, like who is their buyer in the future? I guess like how would you even map out like, or like evaluate a company that's like building in some field that's like kind of abstract?
Well, I think that there's this important nuance behind with deep tech in particular, around how much technology risk there is versus how much market risk there is. I think that if there's technology risk, but there's not a lot of market risk, and what I mean by that is that you're building technology that is 10x better than what's out there for an existing market. If what you do actually happens. So there are like many examples of this, but if you can build GPUs at scale at 1/10 the cost of NVIDIA, like there's a big technical risk there because you may not be able to do it, but there's actually not a lot of market risk because that there's a lot of demand for it. Those are very easy bets for founders to make because you can just assess the quality of the talent, and then the how much conviction you have around their approach on the technology.
Mm-hmm.
I think the important thing that we asked there is like, why hasn't this been done before? Like the why now and why this team? When it comes to these companies where like you take a SpaceX, for example, where there's technology risk and market risk, because it's sort of like, oh, is there actually kind of demand for this? That's where you have to have like this leap of faith on like, okay, is this the right team and the right strategy? And then what do we have to believe in the market for this to happen? Because I don't think anybody that invested in SpaceX at the seed of the Series A thought that realistically that like Elon was going to launch Starlink and that was going to cover the world with internet. And like it wasn't probably until Series C, Series D where that even became kind of like a possibility. But so in those cases, I think that like the way we approach it is like, again, how much conviction do we have in the founder? How much capital are they raising? Because like for those types of businesses, you need to raise a lot of capital.
Mm-hmm.
And so is this somebody who can go and raise like the A and the B and the C based on progress on the technology, knowing that they're probably going to be like, there's going to be pretty limited proof points on the commercial side for some time. Does that make sense?
Yeah.
So a formula for disaster is like, I'm a fantastic founder. Let's say I came from SpaceX and I want to like launch something in space tech, and I want to raise $2 million at 100 million post. It's like nobody would invest in that because it's like, okay, well, it's a high valuation. You don't get your ownership. You don't get the runway that you need to be able to prove out that next milestone, right? Does that make sense? Whereas
Yeah.
those types of deals, they might raise like a $10 million seed round, like just based on a pitch deck theory, some design partners, this type of thing. So
Mm. I wonder when it comes to uh since you just mentioned design partner, so like I guess like a lot of the hardware company are structured in a really interesting way. So they may work with like a design agency that's gonna like front charge like
yeah.
X amount, that's gonna eat up like a lot of the equity and all that kind of stuff. So I guess like in general, a lot of people don't like to touch hardware in general. I wonder what's your perspective on that? And then also, okay, in a more broader question. So I feel like you have a really cool portfolio from various different subsectors, like, and then like I recognize a lot of logos like Lineback or like, from your seed investment to like uh you know like Eaze and to like Matterport. So like I mean I recognize a lot of these brands and like and hims and hers, they're like all in very different subsectors. I wonder as a um so I wonder how do you kind of like quickly study each field to become an expert, or like is there some universal thing that you feel like is universal in no matter what kind of the company is that like you would look for? I guess like how do you like evaluate deals that are in various different sectors quickly?
Ben and I, my partner Ben Ling and I, have both been generalist investors for the past decade plus,
Mhm.
and so I think if you look at the Bling portfolio, we're probably better known for some of our consumer names, just because consumer names are more visible. But we do a lot in B2B. We're investors in companies like Rippling and others. And I think
Mhm.
when it comes to these different areas, we like to say that like we know enough about these various areas to be dangerous, and that when we're investing like early, like we will tend to leverage like the broader kind of Bling community, our product council, our entrepreneurs, folks in our network to really kind of leverage them for due diligence, and then sometimes even expert calls and these things. But ultimately, it still comes down to whether the founder is going after a market that we're excited about. So
Mhm.
that's kind of like the core thing. You had a question around hardware. Hardware is just hard. Like it is
Mhm.
just like I don't know, like multiples harder than
Mhm.
software. There's so many additional considerations that you don't have, but ultimately, if you can do it and you can cross the chasm, like it ends up being, you build like really kind of true differentiation. But it is really difficult. There's a huge number of VCs that just like they just don't touch hardware, and then there's a number. But I think there's a little bit of like this renaissance with hardware, particularly kind of like hardware software, where the hardware might be a bit more like kind of proven and maybe commoditized, and there's really kind of the magic is really in kind of like the software layer that's powering them. There's been a renaissance in kind of robotics, which is actually very tied to AI because of like the making kind of robots smarter. And so I think there's been kind of a renewed interest, which is really exciting. But yeah, I mean, like the way we look at it, Bling, when we're investing, for example, out of a new fund, we care a lot about portfolio construction. So we're not going to do like 80% of our deals in hardware,
Mhm.
like when
Mhm.
like a handful, just like we'll do just a handful of deals that are like that are essentially kind of consumer social, because like very high likelihood of failure, but if it works, like it's incredible,
Mhm.
right? If it ends up being like the next Instagram, the next like TikTok,
Mhm.
et cetera. Yeah.
Mhm. When you're thinking about like portfolio construction, I wonder um how do you like what's your thought process on like having reserves, or like how do would you like invest at like here's like our, let's say we just invest like the same amount to like x amount of company for like a more indexing approach, like how what's your thought process around like portfolio construction?
Um, Well, I think that the very best firms, the ones that what we aspire to, we believe that we're a top performing seed fund. your strategy around follow-on is incredibly important. Like it's not an afterthought at all. So the way it works at Bling is that like we care a lot about like let's say that I lead a deal that if we're doing a follow-on round that like Ben is like highly involved in the decision on like how we follow on, what amount, so on and so forth, and kind of like fresh eyes looking at it. The reason it's important is because like at the end of the day, there's only so many dollars you have on the reserve side, and you want to figure out based on the information that you have, like which ones you want to double down and triple down on. And the very best performing funds will pile as much money as they can into their winners, right? And so that's not always obvious, even at the Series A and Series B. And so having kind of like the right processes to assess like the quality of your even existing investments is really important.
I think that's a really great like insight, because I feel like especially at seed stage, I hear a lot of suggestion is like maybe you do like you do very little amount of reserve, and then eventually you maybe do like SPVs or something for your pro rata. I wonder if that's like a good thought process, or like do you feel like, since you just mentioned like it's very important to have reserve, I guess like how do you calculate on like how many percent that like that's important for like having reserve, or like like I guess like what's a quote like thought process? You don't obviously you don't have to say anything specific, so this is just like a thought exercise.
Well, I think we operate differently than a lot of seed funds. I think there's like a couple of handful of seed funds out there that actually have like pretty sizable opportunity funds, and we're one of them. And so for us, like we have a specific process and investment process around how we think about follow-on and the A, B, et cetera. And so I think if you're a seed fund that just has like a single fund, then most likely you're going to pile on most of your capital just in the initial round and maybe reserve like 0 to 15%, which is probably the right approach if you just have a single seed fund, because ultimately it's your ability to pick companies that will be the winners at the later stages. But we care a lot about like continuing to like maintain, or in some cases even like increase our ownership over time in the companies that we have really high conviction in. So it's just a different philosophy. So I wouldn't say that it just really depends on your fund. We've always had an opportunity fund. When I joined Ben in Fund 3, we raised a larger opportunity fund, and so we tell like our founders that like if the companies are working and we're really excited, like we'd be excited to kind of put more money in. But as a seed fund, we have a agreement with our founders that like the pre-seed and seed is super risky, and so like we need to be able to see proof points in order to put more money in. Yeah.
I wonder, when it comes to like venture as a career, since like you early on you mentioned about like you had a lot of mentor early on careers. I wonder, do you feel like it's a self-educational process? It's mainly a self-educational process, or would you say it's like a hand holding, let me like teach you XYZ kind of process? Like developing your sense of like picking, I guess.
I think the sense of picking is very much, I think, based on the individual. But I think like venture as a whole is very much an apprenticeship business. So like learning the kind of like craft of venture, like it's absolutely critical that you have mentors, because there's just a lot of things that you benefit from having been exposed and understanding different scenarios and getting that pattern recognition. But in terms of ultimately like your portfolio, like that ends up being like every individual will have a different portfolio on the types of companies that they like, the types of because ultimately if you look at like the classic 2x2 metric of like okay, well, is this an obvious bet? And so like if you like it and everybody else likes it, then it's in this quadrant where it's probably going to be really expensive. And then so like you like it, everyone else likes it, everyone else likes it, it's a success, you make a little bit of money. It's like you like it, no one else likes it, it's a success, you make a lot of money. and then not a success, you don't make any money. So like there's this level of like you do have to like be a little bit different than everybody else because you're just doing what everyone else is doing. Like there's no alpha there.
Would you say like, so I guess like since like you have a lot of really great logos on your website, I wonder what is your like what's your thought process on like first of all like encountering these deals? Like, you know, how do you shape your deal flow funnel to fit your strategy? Because I feel like, you know, some people's strategy is to see every deal in the market. We want to see every deal and then we like
It's
we're like
impossible. It's
yeah.
impossible to see every deal. It's impossible
So
to see every
what
deal.
is it like would you really curate where the deal come from?
Well, we care a lot at Bling about continuing to increase the both quantity and quality of our top of funnel. And we really do think about deal sourcing like a funnel. And so, you know, what are the channels that are working for us? What are the channels that we want to invest in? What are the channels that we want to deprioritize? How do we get deals through the funnel very quickly? How do we get like early signals? And continue to like improve that and iterate on that is incredibly important for us, especially at seed. One of the things that I think was really striking for me going from like a multi-stage fund doing seed to series B to now just purely doing seed is that the volume of deals is like, you know, 5, 10x, 20. It's just that there's just so much more deal flow. I think what you were kind of alluding to, like seeing every deal, like that is actually possible at growth stage because the universe of companies is just not as great. And so if you're like, hey, like, you know, these are the 1,000 companies every year that I care a lot about because they have like a great tier one investor that's in the, you know, the sectors that I care about, et cetera, et cetera. Like it is possible to see like the vast majority of deals. The earlier you go, the more difficult it is. And for us, like we don't believe that there are actually like very many proprietary sources of deal flow. Like you gotta just like go out and like continuously reinvent your network, find new sources, figure out things that work for you. And ultimately, like, you know, we're doing, call it, I don't know, 15 to 20 deals, somewhere between 10 and 20 kind of deals a year. How does it kind of ultimately filter down to that, right? And so these are the ones that like we're gonna bet on and we're gonna, you know, spend the time on. Yeah.
I wonder how do you so like since like you're I feel like you guys like is famous for like seed, right? So let's say like how do you build like a network for later stage investors to kind of like having visibility to your current deal? Or like I guess like would you like intentionally build like a downstream investor funnel for like the seed investments that you make? Or like would you say it's more of I guess like would it be like an intentional approach to like I guess like pass along deals to XYZ investor? Or like how do you kind of like build up the network if you don't have one? Or like if you're more early on in your career? Now I feel like it's probably a very easy, you know, you just send a text to XYZ partner at XYZ firm. But before you get there, I guess like how, without like a lot of track record, how would you kind of like build up that like downstream funnel ish?
It's a really good question, right? It's sort of like the chicken and the egg. Like, okay, like how do you kind of get to know folks at all of the places that can like mark up your deals, et cetera.
Yeah.
I think that, you know, just like with Ben and I, like, you know, we came, like Ben was a partner at Coastal, I was a partner at DCM. So like we came from like larger funds where we were like peers of all of the, you know, like frenemies, competitors, collaborators, et cetera, at like all of the different firms. And so like, you know, we got to know them over the course of a decade. And so like now that we're just doing seed, you know, we know these folks, we run on boards with people, these folks. And so like, I think we already kind of naturally had that network. We would continue to build it because again, there's always new folks that come on, there's new firms that come in, there's new partners that come in. And so it's our jobs to continually kind of track talent, like who are the kind of core rising stars at all of the firms, and like making sure that like if they are folks that we believe will be great partners to our companies to form a relationship with them. We care most about the individual that will work with our companies rather than necessarily like the brand and even kind of the seniority, et cetera, because venture is really difficult. Startups are the failure rate is really high, and so like we pride ourselves in like doing the work, like being like the accountable investor, and that's what we're looking for with follow-on investors. It's not just about like the valuation and things like that. It's about like, is this the right partner? Do they have insights? Will they be helpful? And are they going to be there when times get tough for the companies? So that's like the most important thing for us. And so there's a bit of trust that needs to be built over time. To answer your question directly on like, if you're just starting out in venture, let's say you were an operator before, like that's all you've done, and now you're like you're a VC. Maybe you start your own fund. Maybe you're a principal or partner somewhere. How do you build that? And it's just like sales. You got to go out and you got to meet folks. You go to events. I think in the early days, I went to like a lot of just like again like LinkedIn outreach, networking events, these types of things. Leveraging my existing partnership to get introductions to folks that are like at the right level for me, so on and so forth. So
I wonder, so like since like you mentioned about like frenemies, I feel like although I laugh, I feel like it's a lot of truth to it, because I feel like essentially you're competing sometimes and then you're collaborating sometimes. And I guess like it's a really interesting like ecosystem. And I wonder when it comes to like picking your brain or like learning the ropes from like people who are like maybe let's say call it like 3 steps ahead of you. um I guess like how do you identify who would be the like I guess like the coach for you to get yourself onto the next level, whether you are at a fund or what you are like in various different stages of your venture career, like starting a fund or something. Like I guess who would you like how would you identify the person to build uh like to be a part of your like personal board of advisors for like advancing your career?
I think there's a couple elements to that. The first element is who is it that realistically you can get access to, right?
Mhm.
So that's one, is that like how like can you get to somebody in your network and you've identified them and that you think that you have like an introduction to them. And the second is chemistry. Like there's just like it's reality is just chemistry. It's like everybody's busy. They have they can choose what they want to do with their time,
Mhm.
and so is there a good like chemistry? Like I'll give you an example. Like I mentor like folks who are like very early on in their venture career. Some folks that are like not even in venture. Like I had mentored somebody who's now in venture now, but like had at the time was like a senior in college, and it was just chemistry. Like he'd introduced to me through like a mutual kind of VC who said like, hey, this guy is like really smart, et cetera, and I think he was get along. And then I was like, oh, this is great. Like let's we can kind of start like a relationship. And like what I got from him was like when I was looking at a lot of like consumer social things, like, hey, is this like something that like college students are thinking about on your campus, and can you kind of like ask around, like these types of things. And so like I think that like as a VC there's a lot of you have to reinvent your network every like 5 to 7 years, right? It's like it's a new group of people that are coming in. That's like one of the things that I love about it. But it goes both ways. It goes both like for for me to kind of meet more continuously, kind of meet more folks that I want to learn from. Sorry, that's wrong. I can learn from everybody, but like more senior folks than me in the industry, and then also folks that are earlier in their career.
Hmm. I wonder, so okay, so would you expect like let's say, so I'm sure like let's say if you mentor someone, like would the goal to be like, okay, so not you mentor someone, but like also when early on you were the mentee, like I guess like would you have different people for let's say sharing deal flow and also like helping you navigating the like scene inventor? Because I feel like it's like
Of
two
course,
different things, right? Like I feel like
of
the
course.
career development is like one trajectory of things that you need help with, and there's the other one is like, oh, like the people who are actually sharing deal flow with you, because since your mentor may be in a different stage of their career, they may see like some really amazing deals that like I would assume like as a younger mentee, like I don't expect my mentor to be like, hey, here's like SpaceX type of deal, like we're investing. What's your opinion on that? So I wonder how do you kind of like create like a deal funnel for yourself too? On this side, I assume like you're mentoring the college person who is younger, and then assuming you're not gonna like just be like, hey, here's like a 5 hour deal, like would you want to invest, right? I wonder how do you kind of like find mentorship in like both like sharing deal flow and the mentorship in kind of like career navigation.
Well, on the sharing deal flow side, again, like that's generally kind of folks that you feel have a high quality complementary network to yourself. So we like similar deals. We look at things largely in a similar way, and there's like a mutual kind of benefit, and that could be angel investors, that could be other VC firms, that could be like your own network that you've built through building relationships with operators. At Bling Capital, we have our product councils, over 100 current operators, heads of product, heads of engineering, heads of go-to-market. They're all LPs in the fund, and then they will oftentimes see like interesting deal flow. So like from like a firm perspective, like I think that it's important, like as a firm, to kind of like a systematic way of thinking about deal sourcing, which is like which we absolutely do. And then within that, the subcomponents of like the GPs having really kind of like an eye towards deal sourcing. I think one of the things that as the firms get a lot larger and kind of more structured, sometimes like the GPs that don't reinvent their network and continue to kind of like be really active in like deal sourcing, I think ultimately like that becomes a lot trickier for them because like again, networks age, right? So I would say that I don't know if I answered your question directly. It's a little bit tricky to really kind of say like the how. On the earlier stage side, I mean, you can find deals from we can find deals from anywhere, right? And so it could be, and then there's a combination of like inbound and outbound, and generally the outbound tends to be more thesis driven. It tends to be more around like, hey, I want to kind of focus on these specific themes that I'm looking at, and like how do I find people in those themes? But those things are actually quite related because the inbound side, you might find things that you're excited about, but maybe not quite as excited, and you can share notes with other folks that might be more excited. And so like getting into kind of like the flow is really important. And like for us, like we think deal sourcing is a core competence, and so like Ben and I spend a huge percentage of our time doing activities related to deal sourcing.
I wonder, I really like what you said about like, I guess like the partners or like the firms that like you would probably try to get close with, or like you're building a relationship with, is like high complementary skill set people with you. So I guess like in venture, I guess like what would be the core skills that like the VC should be building? Is that like us? So I'm sure like I can identify as like, there's like the highly technical people, right? And then there is like the networking people. There's a storyteller slash like social media manager for every firm. So I wonder how would you identify like the core things that like making a VC fund successful, making you like, popular among like the tier one founders?
I don't think it's any one thing. I think it really depends on the firm. Like for Bling, we're a product focused fund, right? Like everything we do is around like helping founders find product market fit, and we think that that's a relatively differentiated product that we offer to the entrepreneurial community. Like founders essentially are in a lot of ways like our customers, right? We're trying to convince them to take money from us and work with us and partner with us, and so I would say that. Having kind of like building your firm around your strategy is really important. I mean, I think that if you just study some of the kind of generational firms out there, like Andreessen's like ambition is to be like the biggest, like they have like we have the biggest partnership, and we have like all of these resources for you, and we have like the biggest microphone, and like in a lot of ways that works. Like if you raise like such a large fund, it's like every time any kind of meaningful company wants to raise, they're like, oh, should we have Andreessen on our list? Like, can we get an intro to them, right? And that's not our strategy at all. Like our strategy is to be small and nimble and focus at the very early stages and like partner with founders, from inception. And we work with all different types of founders. Sometimes they're repeat entrepreneurs, and sometimes they're first time entrepreneurs. But we're able to kind of in a lot of cases work with founders that we think is very high potential, but maybe like quote unquote undiscovered. And so like they might not be like they don't have like a Sequoia or Andreessen on speed dial kind of thing. But like the ambition is to like eventually right? And so
I wonder, when you mention like undiscovered, like what would be things that your firm look for that's like most other people will be like overlook?
Well, I think a couple things. So I'll say one of the things like we care a lot about is we measure in a somewhat systematic way the potential of the founder. So we're not necessarily looking at like what they've done in the past, like but what they potentially could accomplish in the future based on like a relatively streamlined and structured diligence process that we have that is really kind of more evaluating them as founders. But the way that they think about the world, the way they think about how they're going to build their business, essentially kind of the 0 to 1. So we're pretty systematic about that. And that's something that I think that a lot of seed funds, I think might be a lot of other funds are very much just a more kind of maybe feeling based, or maybe more like they don't really have a structure. Whereas I just like this founder, but whereas we're kind of like pretty maniacal about that. So that's one. And then on the flip side, this is kind of counterintuitive, but we're very data driven. And so I get this question a lot, was like, how can you be data driven when you're at the pre-seed and seed? Like there's no data. And I was like, there's actually a lot of data. It just depends on like the type of data that you're looking for. If there is data on like, because they've now been live for 6 months, like we will almost always kind of like just get all the raw data and then run analytics on it, which we can just do in a very, again, systematic way to figure out like what the bright spots are in the business. It's kind of like what you would be doing at the growth stages or like a Series B or sometimes at the Series A, but we do it like very early just to understand the signals. We don't necessarily need everything to be working because like it's so early. But if nothing is working, then we're like, okay, well, I mean, is this the right time for us to be investing, right? And we can still invest even if nothing is working, but then we understand, okay, like nothing is working. So so that's something that we do that I think is unique. And we're actually gonna have a lot of content about this year. We're kind of in the process of like launching just a lot more content. I feel like a lot of our founders like really kind of know how we work with them in a very kind of analytical kind of company building way. And we want like other entrepreneurs like outside of our network to benefit from that as well. Selfishly, just from like a top of funnel perspective, so people get a sense of like what it's a preview of what it's like to like work with Bling.
I want to be mindful of the time. I want to keep the question short. Okay, so I have like one minor piggyback question on what you said about like, you're diligencing the founders, examining like how they think about from the 0 to 1. I guess like what would be the best answer that you've heard recently about like maybe like how the founder think about their business from like 0 to 1 that you feel like, oh, it was like so impressive?
It wouldn't be one answer because again we have like a system, we have like a set of questions which we're going to kind of talk through. But one question that we always have them answer is like what's the venture scale opportunity? So specifically, how does this company get to 100 and $500 million in gross profit? How many customers do you need, paying you what, and what percentage of the market does that represent? And what's important about that is for you to like systematically understand like how is it that you're going to build a very large business from here, even if you have zero revenue today, right? And if they have like no idea, it's a little bit tricky because it means like, okay, you're just kind of like shooting from the hip. You haven't thought through like thoughtfully, like who are your customers, how much can you get paid from them over time, right? And so we picked those numbers specifically because we think 100 million is like the minimum for it to be like a venture scale outcome, and then 500 is like the minimum for it to be a venture scale home run. And so that's like one example, like one question that we ask, and like founders that do really well in that, we think like it's confidence inspiring, and founders that like struggle in that, it's a little bit of a yellow flag.
Totally. Okay, so I know that you have a hard stop at 11. I don't know if you want to. Okay, so I'll let you go, or like we have like a 1 minute fire round. Do you want to do the fire round?
I'll do the fire round. Yeah.
Okay. What's your favorite book?
Oh, it's so I'm a new dad. So recently I've just been,
Congratulations.
thank you. Everything is around like my son, and like I've been reading this book, like how to raise a smart smart 5-year-old, like
Oh
0 to
my
5 years
God.
old. So I've been starting to like read that. It's been like really insightful. It's a lot of baby stuff recently.
Mhm. Yeah, same. So who
I
made the
also
biggest?
really, I mean, I was a little bit like, I love this book. I mean, I'm in this book a little bit, but like, I love this book, like How to Break into Venture Capital, which my friend Allison Gates wrote, and I do think it's so useful because like you talk to 10 people on the street, and like they just don't know like what we do, and so like I feel like it's like introducing venture to the world. So
Mm. Who made the biggest impact in your career?
um, hard to know. I mean, I would say definitely my partner Ben. I mean, we know each other for 20 years, and now we're working together. I mean, it's super fun every day.
Who would you invite to your dinner party?
Elon.
Where can we find you outside of work?
What?
Where can we find you outside of work?
At the gym.
At the gym. Okay, amazing. Thank you so much, Kyle, for coming on the show today.
Yeah, thank you for having me. It's also great to like meet in person briefly and everything. And congrats on kind of like the all the traction you've gotten with Smart Venture. Let's stay in touch.
Thank you. Awesome.
All right,
Let
take care.
me
Bye.
just quickly end.